Zim Integrated, you wanted it, we're giving it to you. Here's our analysis.
There was quite a bit of analysis on Zim. Zim International, this is a very interesting company because we looked at it back in April, and back then there was just, if you go back to that video, you'll see that in this company there were some red flags that we were seeing that just, they didn't look right. It looked weird to me, and we found out why. Quite a few reasons why, actually. The first main thing is they went public recently. So if you look at the history of when this company went public and what was happening before they went public, you find out some very interesting things. Now, before they went public, they were a private company, so if you're looking at trying to dig into the financials, the only thing you're going to be able to see is what they did to go public. So they're going to report on a few years prior earnings, and you get an interesting picture on what Zim was before they went public.
And it only goes back to 2017.
Right. The earliest we could find before that was we found out that they basically went private. It was an Israeli company that had a very interesting beginning.
Still is an Israeli company.
That's true. Yeah, that's true. So 1945, they were around back then, and they did a lot of immigration for people. I believe that had a lot to do with what was going on with the war at the time. And then eventually, a couple decades ago later on, they went into container shipping. And then they went private. 2004, I think, is when they went private. And then when you start to get closer to the point where they go public, you can start to see some things. Now, in 2014, they had a major financial restructuring because they had some financial issues. We can't see those.
Right.
At least not easily, we can't see those.
Unless you call Zim and they give you a prospectus of, their company back then.
Right.
Good luck.
Yeah. They had this financial restructuring that they went through in 2014, and I guess whatever they were doing at the time didn't quite fully work out, because when you look at their net operating revenue, their income that they were making up until the point where they went public, they were starting to lose money. This was not a profitable company before they went public. Now, all of a sudden, they go public, and boom, all this cash flow. There's just money just coming in all over the place. It's not because they're operating, the actually operating revenue, the money they're making from doing business is not going up commensurate with that cash flow. That cash flow is coming from people buying shares of Zim.
Right.
And
this is the problem, though, is because people are going nuts over Zim because they're paying 108% dividend. They think, yeah, this is great. Look at how much cash they have. Was it 4.4 billion? But they're not looking at the business itself as far as can it sustain an operating budget of 1.8 billion,
right,
and grow that into the 4.4 billion that they have as far as cash.
Now, having cash flow is not bad. Having cash flow is usually a good sign. There's some problems, though. If you look at what's being forecasted in 2023, 2024 for the price of container shipping, the shipping industry as a whole had a huge payday when COVID hit. They made a lot of money. Well, that payday and that party is over. You are not going to be making as much money if you're in a shipping business in the next few years as you were the past few years. A good example, it used to cost about $40,000 to ship 1,000 TEU, that's container units, in 2021 and 2022. Now, so this is 1 year ago, from then until today, that now pays $16,000 per TEU. So if you think about that number, that's a huge cut. That's a big cut.
Right.
So
that's cutting into your operating budget, which equates to loss of business.
Now let's talk about our investment. If we were going to buy Zim, say it's $1,000 to make the math easier, but if you gave Zim $1,000 and you were walking into an environment where the company wasn't profitable before they came public, and if you look at their cost of operations, the cost of their revenue that they're getting, that has gone up more than the revenue that they're gaining from investing with cash flow. So as a business, they're kind of flat. It's not necessarily bad, but they have to do something with that cash to get you a return on your investment. If they're going to do that, they have to come up with some way to, maybe take their ships off of leases, maybe buy a few ships, which they did do that recently, but they have to earn revenue commensurate because you're giving them a loan. So if you did that and, you're looking at what's expecting to happen in correlation to the shipping industry as a whole, that's not doing so good. So remember, they're paying this huge dividend. They've always promised, they want to do 30 to 40% of their net revenue in dividends. That's a big number. That's sensational.
Huge,
That's
huge number.
ridiculous. Very big number. They're going to provide that, and they're going to say, we're going to get this. That number has to come from net revenue. Now, right now, a big share of that is people buying the stock. They still have to take that excess money that Brian talked about, $4.6 billion. They have to actually take that money, they have to invest it. So we're going to talk about what they're going to do with that. The problem is it's been too soon. So if you've got the huge injection of cash and you need to pay it back or invest it wisely, they're just figuring out what they're going to do with this money. So as an investor, you're giving them a loan. How do you know what they're going to do with the money and whether or not it's going to pay off? Is it going to work?
The only thing we've seen them do so far is purchase some ships.
Yep.
Some used cargo ships, which is great. You want to own your ships, and they're going to hopefully get off the lease system with this. That's it so far. I haven't seen any acquisitions.
There was a contract they landed.
Yeah, New Zealand. They got a New Zealand contract to do shipping with them, which is great. That should be some extra revenue, but it's not, I mean, it's New Zealand. It's a tiny little country.
If you're from New Zealand,
sorry.
We still love you.
Go Kiwis.
Brian's right, though. I mean, there's not a whole lot there to show for it yet. And if you're giving them a loan, you have to be able to have something to provide for it. Now, they do provide a service, and that service is staying relatively flat. But what they're projecting, if you look at all these news articles that talk about what's happening over the next few years, we've got one of them from Simply Wall Street. They say the earnings forecasts are average to decline 101% per year for the next 3 years. Now, even in the earnings call from Zim, they talked about their revenue is expected to fall by 31%. If that's not an indicator, Zim themselves, when they're looking at the shipping container industry as a whole, this is Zim, this is them talking, not us. They're saying that basically they're going to be one of the last people with their head underwater because of what's happening in the industry as a whole. Now, that's not a good thing. Now, if you're going to go public and you need cash flow to survive that, it's a pretty good way to do that is you go public and you help pay off some of your liabilities with that. But if they're going to pay net revenue with their dividend, so think about this. If their dividend is huge and they're going to pay you that dividend from their net revenue and they're saying their net revenue is projected to decline by that much, how long do you think that dividend is going to last?
Not very long, because they don't have the money to sustain it. Or they're just going to be bleeding cash for years.
For a while. Now as long as the sentiment is bullish and everybody keeps buying it in, it could end up being like Tesla where, it's an automotive company that is, they're pretty cutting edge.
Yeah.
But, how do they compare with Ford and GM and, Kia and all the other,
yeah.
all the other ones that are out there? It's like, wait a minute, you got these guys here and then Tesla way up there.
The difference is, though, like with Amazon that was losing money for years, Tesla was losing money for years, they're buying into the company and the promise of some new technology or something that is going to lift the company up to Ford, GM, or whatever status those two companies did. The problem is with Zim, we don't have enough data to make any of those choices. I mean, we don't have a product that is promising huge returns or even a steady 16% return year over year for the next 10 years.
Now,
so
they are backed by the Israeli government to some degree because they've had a history with them. But as far as what Brian's talking about, there's not a lot of distinction between what Zim's doing and what other companies are doing. They're all doing basically the same or similar things. Back to your investment, is it a good buy? Is Zim going to be around next year? I think they'll be around. I mean, I think they're going to be a company that still sticks around, but as far as you giving them money and them being able to pay you back, I think you're going to wait a really long time before you get your money back. Now, if you had purchased Zim back in April, it was $80 a share, and now it's mid-20s or lower 20s right now. Well, who's to say, what's it going to do next year? So here's our prediction part. Prediction time. Prediction time. I'll say it twice. So if you're going
to do something.
I can't put a golden stamp on what we think the price will do. I think the price will be commensurate with whatever their operating revenue is of that time. So if you go forward a whole year and you're looking at what the price per share is now, you look at their IPO price, you look at the book value of the stock, you look at the cost of their operations, and you look at what their net operating revenue is, not total revenue. You want their operating revenue to find that out. I think the share price would be reflected in that. And right now, with the net revenues declining and them getting an injection of cash, inflation is going to affect that negatively. The federal rates are going to affect that negatively if they still have leased vehicles, or leased boats. They still have some of those. There's a lot of headwinds here. There's not a lot of tailwinds. There's a lot of things here that make this company as a long-term investment a difficult thing to get your money back. Now, does that mean that we'll never buy Zim?
No, because disclosure, I did buy a whole 4 shares because I want to track it. Not really as an investment, but I want to. It's an easy way for me to see the numbers as it progresses, and that'll let me know if I want to buy more.
So we track it. 4 shares, not a lot. $80, something like that. So
that's my personal, not the dividend dudes.
Right. Yeah. So that stock purchase is separate from this, but the idea here is that if we're going to come back and we're going to look at Zim, we're going to look at it in a shipping container industry as a whole. So those other 2 companies that we had viewers recommend to us, we can look at those in conjunction with that. But it's got to be based on the financial numbers, not just what the financial reports show. We need some history.
Right.
And right now, if you go to Zim and you look at all the stuff that Zim's doing, there's not a lot to see. You can't see analysis reports. You can't see dividend history reports. All the stuff is blank because it's too new.
Yeah. Bottom line, we need more data. We need a larger data set to pull information from. Mm-hmm. And the data set that we have doesn't look great as far as the company's health is concerned, even though you'll go onto the sites that says, hey, they're healthy because they have so much money, but it came from probably people buying stock. One thing that I want to see and that I don't is with Amazon and Tesla. When you look at their numbers, Amazon was trading at $5, it went up. As far as stock price, Tesla, the same thing. It went up to, astronomical, unsustainable because
it was matching
because of people.
Demand. Yeah.
Whereas Zim, you see it at $91, now down to 25. So it's going the wrong way.
Remember, when you're buying a stock, you're giving the company a loan. They owe you they should be able to pay that back. They should owe you some dividends, some capital appreciation in the stock. That takes time. If you buy a company based on a huge dividend when all the revenue and everything else is going down, I think you're going to get an unfortunate launch. My speculation here is that this company is not healthy enough right now to give good returns. So does it mean we ignore it? No, it just means that we're going to come back to it later when we have more financial data, we have more reports to see how this new management, how going public actually affected them. Because once again, before they went public, they were not profitable. It's probably one of the reasons why they went public.
Right. And I would like to see fourth quarter of next year, this time next year, what they did with all that money that they gained.
Yeah, and hopefully they overcame inflation with that, because if inflation's at 8 to 10% and they just sat on it, all that money that people gave them, $4.6 billion, is worth 10% less.
Right.
Buying power. That's not good. So we'll see what they do. Maybe they do some really good things, and at that point it'll be a good buy.
Yep. That's our conclusion. Hold, wait to see.
Yes, and thank you for recommending this stuff to us. Normally when we look at stocks, we see red flags right away, and we'll gloss over it based on those red flags. We understand that if you guys are new to this, you're probably not seeing that as quickly. So if you have more recommendations, please send them to us. We'll keep analyzing stocks as we go, and we're going to change our formatting a little bit. So we're going to get more individual stocks on analysis, and then some of that will come into play with our monthly purchase.
If you want to see how we came to all this, we did a call that we discussed the Zim numbers. It's a really long, mostly unedited version. Go ahead and take a look at it and scroll through it.
It's more like a podcast, but it does cover all the work that was done behind the scenes. Well, not all of it. A good chunk of the discussion behind the work that was done to come to the conclusions that we did. And hey, if we're wrong, we're wrong. But at the same point, this is just the numbers. We have no axe to grind against them. But please watch that. Thank you for watching this. And
as always,
happy investing.